Hello, Kurt Jackson with KJ Financial here. In our second module of our Retirement Accelerator Blueprint, we're addressing the 10 biggest market risks. And we are at risk number 2, and that is market risk, something we've talked about before if you watched our previous videos. So hopefully you remember all the things that we addressed regarding market losses in our inefficiency module, and that's where retirement risk number 2 fits in, and that's market risk. See, market risk is a huge risk while you're building your retirement nest egg, but it becomes an even larger risk in retirement when you're taking out income to live on. The rules change, your needs change, and the importance significantly change when you move from the accumulation stage of building wealth for retirement to the decumulation stage where you are turning your retirement nest egg into a monthly retirement paycheck that must last your entire life. And if you're married, it must last your spouse's entire life also. So if you'll recall, we talked about how you can never afford to lose money. Well, our research has shown that to absolutely be the case when you're officially in retirement. So in retirement, you don't have much time to try to recoup losses. And recouping losses becomes even more difficult when you're taking retirement income from your portfolio and paying fees. So not that you have time when you're younger to recoup losses. Remember our example in our third episode. It can easily turn into a horrible cycle of losses on top of losses, which is compound and turbocharge the depletion of your retirement portfolio, and then you're throwing in those fees that are guaranteed losses every year. It just can suck the life right out of your portfolio. So remember our video on sequence of returns. You saw the significant difference between having 2 good up years when taking income versus 1 good up year and then starting with 3 down years. It's critical to understand this. When you suffer losses within that 5 to 10 years before you retire or the 5 to 10 years after you retire, it exponentially increases your chances of outliving your money. It is certainly the enemy of a successful retirement. Luckily, you've had a quick peek at an alternative that protects you from losses and has shown to perform very well in a real-world hypothetical example. We're going to dive deep into this in the next video, where we address withdrawal rate risk. So go ahead and click on the next video below.